Alrighty, hello everyone, and welcome to the Inner Circle for the session that we have scheduled for this month of February. If you can see me, if you can see my screen, if you can hear me well, please type it in. Say yes on the Go to Webinar Control panel that you have on the right hand side, and that will be great so that I know that we are good to go. And I see a lot of people here today. Lori, Philippe, Gerard, Tariq, Michael. I mean, fantastic to have you all here. I'm just gonna make sure here that I have everything, that I'm recording everything. All right, and I can see here all the different attendees as well. So hello, Elio as well. I see Mark. Hello, Mark. Morstalisur, Prakash, Robert, Scott. I mean, great people. Obviously, I know as well many of you already. It's been some time since many of you guys have been also on this program. So again, the idea of today's session is again to make it very engaging. So whenever you have any questions, anything, you're here obviously to learn. So just feel free to type in your question, and we will be covering it in detail. Again, we will not be disclosing any last names or anything like that to keep the privacy. But obviously the more engaged that we can make this, the more that you can be involved, the more that you can avoid being shy and just asking away, whatever you're dealing with on your own fundraising efforts or whatever you're dealing with building your own company, like let's just, cover it. So as always, I like to start every session with a quote. And the quote for today is that opportunities don't happen, you create them. And it's interesting how people talk about luck. People talk about being lucky, right? That, for example, someone comes out on TechCrunch that they've raised 200 million or 300 million, and people are like, "Oh, they're so lucky," right? The thing is that luck you create and you generate luck, because luck is at the end of the day opportunity meeting preparation. And that is what luck is. Luck is not that things all of a sudden fall on your plate. You need to be there, for it to happen, to you, and then you just take it and run. In today's session, I'm actually going to be covering some very interesting stats on pitch decks. I was actually putting those together, and I thought it was pretty mind blowing. Some of the data that I was able to actually collect and gain access to, and I hope that some of this data, is going to be guiding you as you are approaching your own fundraising efforts, as you are dealing with investors, and just getting the word out there to really, make it happen with your own fundraising. So let's go into it. Obviously, as you are out there, as you are engaging with investors, as you are pulling the trigger on telling the world that you're raising money, you need to know how you're performing. You need to know whether you're doing a good job or you're not doing such a good job, and where there is room for improvement. Now, some of the things that you could do to measure success could be any of the following things that you see right here on my screen, right? So one could be, I think that the way that you should always think about this is you should always use a CRM. You can use the CRM template that we have on the Inner Circle, but you should always use a CRM where you can see where you're at with each one of the prospects every step of the way of the fundraising process. Now, think about this as sales. It's just like sales, because this is a sales process, what you are developing here. So essentially what you want to know is, how many pitches have you done? You can write that down on the CRM. How many pitches are you increasing as you are continuing from month to month or from week to week? Also, you can take a look at what is the amount raised per investor. If you take a look and you go back to your CRM and you see all the people that you have been pitching, how many have you actually been able to close? How much money per investor if you really grab it as a whole? The other thing that you could use or that you could do is pitch deck views, right? You could perhaps, and I don't really like this method, but it's one where you could track this, like using methods like DocSend, where you just dump in your deck in there, and then you can distribute the link, and then you know who is clicking on what. You can do that. I think that another way that you can go about this is you can combine this with a, for example, email open rate, where you have included the link to your own pitch deck. Maybe it could be the link to your Google Drive folder, what that is contained on the pitch, that contains the pitch deck, or the Dropbox folder that contains the pitch deck. So you're just sharing the link. But ultimately, what you're doing is you're tracking the email, and you know how people are engaging. Now, if you see that someone is opening your email 50 times, 60 times, 100 times, you know that there's engagement and that there's interest. Maybe what they're doing is either opening it themselves, or they are forwarding it to other people in the firm or in their network, so that they can co-invest and also be, giving their own feedback. Now, these are the people that you want to prioritize. Obviously, one person that is not opening your email at all, there's probably no interest. So maybe what you can do is take a look at, let's say, the 100 investors that you're engaging with and that you are exchanging emails, and see which one of those is investing the most amount of time on their schedule to open your email and to review your email. I mean, that's a good way to really prioritize and understand who maybe you want to allocate more time to. Now, another thing that you can do is time spent on pitch deck. Like, you can track this, maybe like if you have it embedded on your website, for example, you can see, like how much time, they spend, each session on that specific page. You can also take a look at the data room, so your diligence room views. And by the way, if you want to create a really good diligence room, I would highly recommend that you take a look at this post. So just go on Google and type in due diligence Scrematis, and then when you go on my site and you open this specific article, I would highly recommend that you create a diligence folder that is following the guidelines that you would be able to see on this specific article. Again, just / due diligence, okay? And here, as you can see here, your due diligence checklist, just follow it. There's going to be certain things that apply to your business and other things that are not going to be applying. So for example, in this case, if you're at a seed stage, there's going to be some stuff here on the checklist that applies more to like a Series B or a Series C. So just move over to the next one. But the way that you want to have this in your diligence folder is folders into subfolders, and basically in a very structured way, so that whenever that investor is ready to dance, they're interested. It's not like you're waiting for the one-offs for them to say, hey, can you send me this document, or can you send me that document? You can just say, okay, great, here's the link to my diligence folder. Let me know if you have any questions. Now, that diligence folder is what you may be tracking. You want to see who is going in there, like what are they looking at? Where are they spending the most amount of time on? That's the kind of stuff that you want to keep a little bit of track on what's going on. Now, the other thing that you can do, so that you can see like the level of interest and diligence that maybe they're doing, you can go into your LinkedIn, and on your LinkedIn, so for example, if I was to go on my LinkedIn, you can see like who is actually interested on what you're doing. So if I'm going just as an example here on my own LinkedIn, right? I think that you should definitely have the premium feature. I think that it really pays off. But what you would do is you would go here, you would click on your own profile right there on your picture. And then once you click on your picture, you can see who are the people that are essentially on. There's a feature there that says who has viewed your profile, right? So you would go then into that specific feature that you have in your own profile. And let me show you where it is. So it is right here. Let me just see it for this thing to load. For some reason, it's taking a little bit longer because I am sharing my screen. So you can see here who's viewed your profile. So then on who's viewed your profile, you're going to be able to see there what are the specific individuals that are looking at your profile, that are doing due diligence on you at a personal level. Probably they're going to be doing due diligence on your co-founders or other team members as well. But here you can see everyone, right? So obviously, if you see some of those folks that are investors that you're engaging in with, and that you're definitely interested in getting an investment from them, basically what you just do is you just reach out to them and you use this to really know who is taking a look at you. Because if they're taking a look at you, it means that they're interested in what you're doing, no? So LinkedIn views could be a really good way for you to engage those people that are showing interest and perhaps to close them Obviously, as you go and you see like how those views are performing over the course of time with investors, if that's going up and it's trending upwards, you know that you're doing a good job. And again, the other thing is the email open rates. Again, if you guys have any questions, feel free to type them in. Now, what happens, when you're losing investor interest? Maybe, like you're now caught up in the middle of it. Let's say it's not going as fast as you would have hoped, or there's people that are going dark on you. Like, how can you avoid this? How do you get to a point where you're building momentum and you're keeping people excited? One thing is that you don't want to start too late. You want to start very early. So literally, when you have the idea of potentially needing to raise money, you need to start building the relationships with those people, right? Way before you need the money. Now, this of raising money, it's like forming a storm. You need to create the perfect storm, because remember, as I have said many, many times, that what drives checks at the end of the day is the fear of missing out, that FOMO. So you want to create that FOMO. Now, some of the tools that you have to your advantage here could be PR and marketing that you could use. I mean, you could perhaps retarget, that specific investor on their email address. You can perhaps get a feature on the press, that on the press outlet on the media outlet that they typically read. It could be, let's say, for investors, a TechCrunch, right? Or maybe you have your product on a product hunt, that is shown to all the investors that are typically going there and seeing what kind of products are getting traction. Also, you always want to keep it short. The attention span is very, very small, so keep those touch points, to a minimum, so that you're not overwhelming them. And always remember that fundraising is all about listening, it's not about talking. Then the other thing is, when you go out to market, you're going to see that you're going to lose investor interest if you're going out there and you have nothing going on your round. Literally, you are at zero. And for that reason, you always need to avoid this from happening. You're never fundraising if you are at zero. You're just going for advice. As I have said multiple times, you go for money, you get advice. You go for advice, you get money twice. So that's where you always want to be. You always want to be on the advice side, but always remember that whoever is going to be your lead, then you grab that and you use that against everyone else. And that's at that point where you say that you're raising money. So when it comes down to amount committed and going to market, you want to at least have 20%. So when you're announcing to the world that you're raising capital, remember, the clock is going to start to tick. So you're going to have about 3 to 6 months to close the round. If that's not the case, you're screwed. So always go to market with something to fall on. So that needs to be 20% or more, ideally, of the money in your bank account and ready to go. Now, the other thing is, you want to follow up, but you also want to be very strategic with your follow-ups. Perhaps there's an investor that is going dark on you. That's totally okay. You don't know what they're dealing with, but you want to be very creative, very strategic on how you are following up. You want to avoid the noise. Don't go with a, hey, just wanted to check in, let me know your thoughts, this, and that. Go with stuff that adds value, because the investor, ultimately what they want is, they want to see that you're delivering on your promise. So what you would essentially do is, you would perhaps talk about maybe some feedback that they gave you, how you implemented it, the difference that it made, and things like that. And always finish those interactions with a call to action. Are you available next week or the following for a quick catch-up call? Question mark. Because your goal is always to get to the next meeting. The more meetings, the more concerns that you get to address, the more concerns that are addressed, money's in the bank. And lastly is the updates. One thing that you guys could do is, you could create like a newsletter that you send like maybe like every month or every couple of months, to people that you think could make a difference for your business, whether it is top advisors, top investors, people that could make a difference to your business. And essentially what you do is, you break that newsletter down on KPIs, on accomplishments, on mentions on the press, on changes on the team, so that they are up to date on where the business is at, because that's going to come a long way, especially when you need to raise subsequent rounds, so that you're not like educating people from scratch. It's people that have been following it and that are ready to pull the trigger. So that's very, very helpful, no? All right, so let's hear. I want to hear Tariq. So Tariq has a question here. Hello, Tariq. How are you doing?
I'm very well, thank you. Appreciate it. So I tried
So
to
Tariq,
reach out to.
very quickly, Tariq. So in 20 seconds, so that everyone else, has an idea of what you're up to. What are you doing? What's your business about in less than 20 seconds?
So we have created an automotive e-commerce platform where we have fixed the price of the car, and it's only for the new car as of now, and it's only in Canada.
Okay,
Um, I
fantastic.
I have tried to reach out to investors on LinkedIn, and I get a response. And then I got some pitch deck demonstration as well. I have not started the email campaign. So I'm not. I don't have any metric in terms of is the LinkedIn messages is better than email or vice versa. So I'm
Okay.
asking you because you have mentioned this kind of flow, and it looks like email would work better to make it part of the CRM and create a proper metric. Should we go to email or stick with LinkedIn?
So Tariq, so my piece of advice to you and to everyone else is that whatever you're doing, don't do it anymore because you should never reach out directly to an investor. That's a big mistake because more emails or more messages could lead to more meetings, but more meetings doesn't equal to more money because the thing is that investors for a living they meet with entrepreneurs. That's what they do. The more that they have on their ecosystem, the better because then they're going to be using that as leverage towards their LPs, which are the investors on their fund, to show that they have a great pipeline of deal flow. Now, the way that you always want to approach it is going indirect. And now, it's interesting how when I speak with people, they tell me, oh, I need access, I need to meet investors, we live in a different world. 15 years ago, that was the toughest part. It was like doing what you're doing, like, hey, let me just email everyone I can and see who I can get in front of. But now we live in a world that is more transparent, is more connected, and is easier to get in front of people. So the way that you're going to do it, and now obviously it has turned. So it's not about getting access to people, it's about closing the people that you can get in front of because we live in the information world right now where there's this constant flow of information happening left and right. So the way that you want to go about this, Tariq, is the following. First, you grab the list of investors that you want to go after. So let's say maybe you've researched and you've come across, the perfect list on LinkedIn. Fine. You got the list, you got the prospects. Then number two, what you do is you're going to go on websites like Crunchbase and you're going to see what are the most recent investments that that investor has done. So what you do then is you reach out to that entrepreneur that has received an investment in the last 6 to 12 months from that investor that you want to target, and you reach out to that entrepreneur to connect. You have a conversation with that entrepreneur, and then you ask that entrepreneur to make the introduction to their own investor. Now remember this, because I call this the success, or the win-win equation. That entrepreneur of the portfolio company, they're going to be very incentivized to introduce you. And I'll tell you why. In 18 to 24 months, they're going to need more money. They're going to have to go back to their own investor. If that investor doesn't reinvest and does not execute on the pro rata right, that's going to send a negative signal to the market. And people are going to be like, hold on a second, that investor has the money, they're not reinvesting. Perhaps there's something wrong with the business. So, for that reason, and for the reason that they get to add value to their own investor by introducing you, is a win for them to make the introduction. For you, you need to get, it's not about more meetings, it's about quality meetings. And you get those quality meetings where someone is introducing you that is already part of that circle of trust and that makes that introduction that comes with the social proof that you need where trust is present. It's like when you go to like a party or a conference, you're speaking with someone, they have a cousin or a sister that versus someone that you don't know from nothing and you get to start, a conversation with. That's the difference of being comfortable at the conversation and just getting to know you for the very first time. It's a massive difference. You get to reduce as well the amount of time from first touch point to money in the bank. So going back to your question, Tariq, don't do any of that stuff anymore. No more cold emails, no more cold LinkedIn's. And that goes for you and for everyone else that is listening. You need to use founders of portfolio companies to get you in. Tariq, does that make sense?
That perfectly makes sense. Actually, we lost a lot of time. I
Okay.
really appreciate your feedback and
Now,
suggestion.
now,
Thank you.
now, now, when we talk about LinkedIn, right? So imagine you're receiving all those introductions from those founders, because literally with one single meaningful conversation that you get with an entrepreneur, Literally, you can say, oh, would you mind making the introduction? Oh, yeah, sure. Oh, great. Well, let me follow up. And what you do is, let me follow up with a blurb, which is just one single paragraph that they can copy paste for the introduction. Literally, from one single conversation, you can get 5 to 10 introductions to their own investors. Now, here's why you use LinkedIn. You use LinkedIn because once you get the introduction, when you start seeing, like on the who's viewed my profile, like maybe you see like colleagues of that investor or partners of that firm or friends of that specific investor, then you're going to know that there is interest. And that's how you are using LinkedIn to really gauge, to really understand and measure the interest, but you're never going direct. Okay, Tariq?
Oh, thank you very much.
You're very
Appreciate it.
welcome, Tariq. All righty. So in this case, what I want to do now is I want to jump now into I mean, there's a lot of people, you know, like of you guys that are and gals that are joining today from all over the world, from all over the world. So what I want to make sure that you all understand is that the place where you want to raise money from is the US. And the reason why that's the case is because US investors are very sophisticated. And it's not about the money. It's never about the money. You always need to turn it around and know the network that this investor has and how you can leverage that network to help you in getting to where you want to be. At the end of the day, for them, the money is what justifies their investment and their involvement. But for you, it's not about the money, it's about the network because there is no shortage of capital in the world. So, why US investors? Number one, they have bigger funds. So if they come in, they could potentially reinvest as you go from financing cycle to financing cycle. Number two is more aggressive money. It's not going to be so much of, oh, let me see your revenues. Let me see. It's going to be more like, let me see what you're capable of. Let me see what kind of growth you're experiencing. And I'm jumping in and we're doing this together. And number three is connected money. Because when you go after investors, you want to know four things. Can they introduce you to talent? Can they give you access to more distribution via partnerships and phone calls that they can make? Can they help you with perhaps M&A opportunities? You know, like companies that maybe they can call to buy your business out, you know, in the future. Or can they perhaps, you know, like give you access to more money, right? Or whatever that is. But I think that distribution is a critical one, especially if you are early stage. Now, where do you find those? Especially if you're outside of the US. You can find them in schools. You can even do a master's degree, you know, like in the US, come to the US and do like whatever program of studies. Also a great opportunity for you to meet a co-founder. Startup accelerators are great. Again, my two best ones, Y Combinator and Techstars. The rest, for the most part, is noise. And it's noise because you can grab that equity and just distribute it amongst advisors that have specific accountabilities to your business. Number three, startup competitions. You can, you know, join some of those business plan competitions, startup competitions, whatever that is. Then platforms, you know, crowdfunding platforms, for example. Not a big fan of crowdfunding platforms because of the regulations that are applying right now, given the Jobs Act, the way that it was implemented, but still a place where you can find, you know, investors. I mean, there's also some other sites like AngelList and stuff like that where you can see the signaling and what's happening in your specific segment. Another place is via emails. You know, like you can either get those introductions or like last resource, you just reach out and do something super personalized. And then lastly, social media. You know, there is places like things like Clubhouse. So Clubhouse has recently launched, and Clubhouse is amazing because everyone is at the same level. You can literally join a room, you know, maybe that is about your industry, maybe there's investors in there, and that's your time to shine. So that's how you can really build meaningful relationships, how you can be top of mind, and how you can get those US investors to hopefully, you know, come in and make an investment in your business. Because the thing is that, to give you an idea, like I'm originally from Spain, from Europe. The largest fund in Spain is literally 100 or 150 million. That's it. So what that means is that past a Series A financing round, I'm screwed because I'm going to have to come to the US. And at that point, probably it's going to be too late. The earlier that you come to the US, the better. The longer that you wait, the more that you've maybe messed up your own corporate structure, and the tougher it's going to be to come here and raise money. Now, let's go into some interesting stats on pitch decks. The first one, 1,000 pitch decks are created every day. I mean, that's insane, but that's the truth. There's a lot of people out there, a lot of pitch decks being created, and it's not about putting together a bunch of slides. It's about putting the thought and really trying to understand when this guy or this gal that is specifically investing in my domain, when they see this, what kind of concerns are they going to have? And it's all about you being able to put yourself into those slides and then understanding that other person, in their own shoes, reviewing this and trying to address the concerns right away, because you only have 2 minutes and 41 seconds, as I put underneath, to really capture their attention. That's it. So put a lot of thought and try to understand those investors that have developed an investment thesis that to invest in a business like yours, in your segment, that are also meeting with some of your competitors. You need to know what are some of those concerns that are forbidding them or making it impossible for them to deploy money. Then, like research says that literally with 10 slides alone, you can make it happen. But obviously, it's all about putting the wrapper. So it's about putting the cover slide, the back cover slide too, maybe like an executive summary. And then maybe you get it up to like 15 to 20. But typically, like the most important ones where it's going to make a click for the investor is going to be about 10 slides. That's it. Font size, 30 points. Again, always be very mindful that you need to combine that balance between images and text, because that's going to make all the difference, because these people are skimming through your presentation, okay? All right, and again, if you have any questions, just feel free to jump in. We will be covering them in detail. All right, next one, more stats. So only 1% of pitch decks get funded. Now, there's much more than just putting together a pitch deck. It's the way that you can deliver it, is the way that you're sending it, to who you're sending it. But one of the things that is true and that I really come across is that the pitch deck itself is not something that you get on a phone call and you say, hey, is it okay if I walk you through my pitch deck? Don't do that, because the truth of the matter is, and excuse the language, is that nobody gives a shit about your pitch deck. Nobody gives a shit about your pitch deck because they care about you. They're investing in you. And that's why on most of those meetings, what you need to have really nicely done is not so much the pitch deck, but it's more the narrative, is your why, your what, and your how. And what I mean with this is your why is how you came up with the concept, where were you coming from, what was the triggering event that pushed you over the edge, the what is the market, why is the right time right now, how is this increasing over time, I mean, how big it is, it has to be 1 billion plus, otherwise it doesn't justify the risk. And then the how is the accomplishments, the milestones, the team behind it, what you've done so far, what's the outlook, and finishing that on a very high note. And I find that the storytelling side that goes above and beyond the pitch deck is what makes all the difference. And that's where most people miss the boat. So again, nail it on your why, your what, and your how. Because if you nail it on that, you have a lot already, done, in the process. Because ultimately, investors, in the first 2 minutes of the conversation, they're going to know if they want to allocate more time to your opportunity or not. That's all it takes, 2 minutes. That's why they talk about pattern recognition, because pattern recognition reminds them of certain things that have worked in the past and certain things that didn't work in the past. And they're going to be putting you into one of those buckets. So again, storytelling is everything. And as I have shared on other sessions, make sure that you also watch the video of Steve Jobs presenting the iPhone in 2007, the way that he uses the linguistic, first time, revolutionary, extraordinary. Elon Musk, the way that he presented the Tesla Powerwall, just the level of authenticity, that's all amazing. And that needs to come across when you're doing the storytelling. Now, in terms of a seed round, what's the timeline, right? The timeline is about 12 weeks. That's it. That's it. And that's why, I always say that if you've been at it, if you have been out in the market for quite some time, you're not getting momentum, you're not getting traction, there's no potential investors coming in, there's something off. There's something off either with your story, fundamentally, with you, with your business model. There's something off, because you can't be for such a long time fundraising. You need to go back then to the drawing board. You need to reflect back on some of the concerns that those investors have been sharing with you on what they thought that it could work or it could not work. And you need to put that, and really identify the patterns of that, because all of those concerns are essentially what separate you and the money. So you need to, during especially the first 5 meetings, write every single question down, because then all those questions, all those concerns continue to repeat. So that's exactly what you want to do. Now, always remember, most viewed slides, where you want to spend the most amount of time on competition. Again, who is out there? You're going to be putting this in like with the y-axis, the x-axis, and then obviously yourself always at the top right. Again, don't try to forget about people on purpose. Don't put everyone in there, because then people are going to think that you don't know your space. Then the other thing is the team. The team, slide, put it in bullet points. Again, first bullet point could be the experience. Second bullet point could be the major accomplishments that you've done, you and your team members. Again, you want to go with the leadership team. Don't try to put everyone in their mother, and put maybe some logos of major corporations that the team has worked at, because that's going to help with social proof. And keep in mind that it's amazing, like the difference that you can make when it comes to the financials. Only about 58% of successful pitch decks include a financial slide. This is your time to shine. The number one slide by a mile that investors spend the most amount of time on is financials. People don't even include it. And if they include it, what they do is they just grab a screenshot from the financial model and they dump it in there. And that's a mistake, because again, investors don't have the time. They don't have the time to read through absolutely everything. So essentially what they're going to be doing is they're going to be skimming through the presentation. So if you put a screenshot there, they're not even going to look at it. So you want to put it in a format that has nice design, that is easy for them to digest, that they can really get, how money is coming in, how money is going out. So that's going to be really playing a critical role for you, no? All right, so let me have Robert has a question. So let's see, Robert. Hello, Robert. How are you doing?
Excellent, Alejandro. Thank you very much. How are you?
Very nice to have you here today, Robert. So for the people that are listening here with us, what do you guys do in 20 seconds or less?
We are a smart motion picture studio, approximately 2 million square foot, that's going to help move the motion picture industry to the next generation evolution of cinema, media, digital content, etc.
Very cool, Robert. So then tell us, what's your question?
So I just had a discussion with my I have investors on the East Coast who are interested in this project. Nice. And my contact is a gentleman who has a global marketing and PR firm, a very successful. They market to Rolls-Royce and everybody. And he just left California. Last time I talked to him was a couple months ago. He moved his entire company from California to Texas. There is a large migration. Elon Musk just moved Tesla from California to Texas. Oracle just left California, moved to Texas, and there's going to be multiple corporations and businesses leaving California. He suggested that California is having an anti-business kind of attitude. There's high taxation. We had 200,000 people leave California last year alone, and there's going to be more this year. So my question is, in a nutshell, do we stay put in California, or do we follow big business migration?
Yeah, I mean, I think that that's a great question. Obviously, like for some of those really big corporations, just like a couple of percentage points, on taxes or whatever that is, we're talking about like hundreds of millions. I think that everyone should be, taking a look at their own position. I mean, without a doubt. Yesterday I remember I was speaking with someone that has built a business, that is in the billions, and I asked him, and I said, what's the typical advice that you give entrepreneurs? And he always told me, follow the money. And he said, like that he made the mistake of not doing that at the beginning, and he made a lot of mistakes. Like he failed, back to back. I mean, this guy actually sold his last company for 3.9 billion. So basically, you know, like before he went there, I mean, he got that exit. I mean, he had like 2 or 3 failures, and he learned a lot from that. And he said, my biggest recommendation is to follow the money. So look, I guess it all comes down to your segment. You know, it all comes down to your segment. I mean, if, for example, like yesterday, to give you an example, I was no, it was last week. I was reading the news, and basically was saying that there is this small community. It's called Andorra, outside of Spain, that now apparently is like the place to be if you're a YouTuber. And all the YouTubers are going there because of taxes or the ecosystem that they're building. But I think that, you know, going to where your segment is, it allows you to gain access to more talent. It allows you for perhaps, you know, getting to know some of the thought leaders in your space. It allows you as well to gain access to money, because if investors are interested in investing in that space, they're definitely going to go there, and they're going to be, you know, scouting around, and you definitely want to be, you know, part of that group too. So I find that following the money is a real thing. So again, I don't think that, obviously, you know, if you're taking a look at those movements, you know, you got to see what kind of companies are moving. Is it companies very similar to yours? And is there like a massive exodus? Then if that's the case, you got to go too. Now, if it's, you know, a bunch of companies in SaaS, when you're like in the film industry, then, you know, or it's in the car industry, you know, and you're in the film industry, then that's different. You know, we're talking about a different, you know, type of game. So I think that, Robert, to your question, you got to really take a look at whether or not it's going to be favoring you, given perhaps the network that is going to allow you to gain access to. Because I'm never going to get tired of saying that business is not about what you know, it's about who you know. So you always need to be surrounded by the people that are going to be elevating you. It's like that saying where if you go for lunch, you know, and there is 5 idiots at a table and you're the 6th one and you're not an idiot, you're probably going to be the 6th idiot. And if you arrive at lunch and there's 5 really super successful people and you're the 6th one that is still not successful, you're going to be the 6th one that is going to be successful. So I think that you need to surround the people yourself by the people that can elevate you. And if that requires you to make the move, then go ahead and do it. If not, you know, just stay put. But hopefully, you know, Robert, that gave you, you know, my 2 cents.
Yeah, thank you. I mean, I mean, the film capital of the world is LA and London. We all know that. But the investor, what my concern is that the investors are looking at California. Are they going to invest in us in California? They might not invest in us in California because of what's going on in California. But still, the film industry, the talent pool, everything is still here. It's not, that's not changing. It's big business, big money that's moving out of California, and the taxes are so astronomical, but the film industry is staying put. So it's something that, it's that option, like you were telling me about your other friend who didn't follow the money, who failed several times. That's exactly my conundrum right now on the scales. Yeah. Can I have a headquarters in Texas or New York or somewhere else, and can I have and still do business in California, or do you have to be, like you said before in several meetings ago, you have to be where the business is?
I mean, maybe one thing that you could do, Robert, is so that you can really like base your decision, you know, on data, is take a look at some of the transactions that are happening in your space, and then see like where are those companies located, and if there was like any movements that they did. And again, this goes back to the saying, follow the money. Always follow the money. Okay.
Right. Thank you, Alejandro.
Amazing. Thank you, Robert. So let's continue here. So on the next slide, you know, I wanna throw in here, you know, a few more stats. Typically, you know, when it comes to delivering your pitch deck, it's going to be about 20 minutes. Typically, what they give you, I mean, it could be about 10 minutes too, you know, depending if you're doing like in a maybe like a partners environment or an angel group, you know, environment. You know, it will be around 10 minutes, 5 to 10 minutes. If it's a dedicated presentation, you know, like maybe you go like on a, I don't know, maybe like it's like the absolute last step, like a partners meeting, or, you know, maybe it could be like a presentation at a competition or something where there's going to be some investors in the audience. You know, maybe it could be around 20 minutes. And what you want to do is you definitely want to break it down, you know, slide by slide on how much time you're going to be allocated to each slide. But you also want to be very mindful of some of the slides that are going to be the most important, because the last thing that you want is to be dedicating time, more time to the, let's say, the problem slide, when you know that the team, the competition, and the financials are the three most important slides, and you're actually cutting time because you want to dive a little bit more, or you got derailed on that problem slide. So you want to make sure that for the top slides, you're allocating the most amount of time. And again, I think that I always tell founders that you want to make sure that there's not a single question on turn. So when you're touching, especially on financials, on the team, and then also on the competition, you want to ask if they have any questions. Now, typically for early stage rounds, right now when we're talking about seed and we're talking about Series A, the typical amount that you're seeing is anywhere between 250,000 to 2 million on seed rounds. And then on Series A, it goes up to 5. Series A is interesting because now it's going all across the board. I mean, we just, for example, advise a company at the advisory level on Pantera that they raised the largest Series A in Latin America. It was 100 million Series A. Now, the problem with this is that, that's an exception. Typically Series A's are 5 to 10 million. So you need to have those amounts in mind. You also need to know who is investing and who is receiving what amount of money in your own space, because that's going to be where you're going to be falling into. Now, you want to be very careful when it comes to amounts and to the ask, because if you go to market with an ask that is off, with an ask that is not in line with what some of your competitors are raising, then people are going to think that you don't know what you're doing. So be careful with that. Now, imagine if you're raising, let's say, $2 million, right? And you have just 10 slides, just to throw a number. That means that each slide is worth about 200,000. So those slides, you need to spend a lot of time on, because they can make and they can be worth so much. So always remember that. It's each slide is critical. The cost range to really develop a pitch deck, it could be anywhere from $1,500 to $50,000. I think that if you have the money, I would absolutely recommend it, that you get someone to come in and help you with putting something that is professional, with putting something that is going to resonate. So don't try to do everything internally sometimes, because then, you may be missing the mark there. Now, trust is everything. That's what ultimately it really drives the possibility of someone believing in you, the possibility of someone saying, hey, I'm going to be giving this guy the money or this guy the money, because they have the skill set, they have the passion, and they are delivering on what they're saying. Because trust is built on integrity. And integrity in fundraising is everything. Integrity is, at the end of the day, delivering on your word, on your promise. And you're never going to get a check day one. It's going to be building up over the course of time for that investor. And at one moment, after, let's say, a month or two that you had your first meeting, they're going to see, and it's going to click for them. And they're going to be like, this individual is performing, is delivering. I'm going to invest in this individual. And that's how you really get it done. Now, you want to do a couple of things before you send the pitch deck. You want to definitely build that trust. And how do you build the trust before you send the pitch deck? And before they see clearly that you want to go through an angle of maybe like getting money. You want to connect on a regular basis. You want to go to meetings that they go to. You want to maybe like even comment on their blog, on their tweets or stuff like that, so that you're top of mind and you get on the friendly zone too, because these people, they invest in entrepreneurs that they like, entrepreneurs that they enjoy their company, in addition to what they may be capable of, but they're going to be investing a lot of time sitting with you on the board, maybe even traveling with you, stuff like that. So they want to know that they like you, period. Then the other thing is, when you're out there, when you're engaging, when you're building relationships, you need to have an online presence. Because if you meet someone and that someone, you Google them and there's nothing coming up, whether on them personally or on the business, that's a big no-no. That's a red flag. They're going to go to the next. Remember that fundraising, the investor is always coming with a mindset of, why should I not invest in this business? So don't give them reasons. Make sure that your Crunchbase profile is up to date, your AngelList profile is up to date, your Facebook page, your LinkedIn page, your Twitter, all of that should be up to date, and that you don't have like crazy stuff on your profile. Like, for example, I have someone that we were helping on the advisory, and I took a look at the LinkedIn, and I saw that the LinkedIn said I'm in the middle of looking for pineapples in the desert, something like that. And I said, I think you should change that, because if someone sees that, they're not going to invest in your business. You wanna keep it serious, you wanna keep it professional, and so forth. Again, press and media, that's great to really build that trust, to really perhaps have more links, more entries on the internet about you and about your business. Raising money, like we said, having that lead investor that has given you some money so that you don't go to market starting from zero, so that you already have those signalings from other investors that have invested in you. That's also great. And then ask as well how you can add value for them. Like maybe one of those investors needs an introduction to, I don't know, to like a podcast, or to another entrepreneur, or to maybe like a reporter, so that they can talk about whatever. So always think how you can add value as well to them. Not just them giving you the money, but how can you add value to them and to their own interest. Do what you say, again, what we're saying. The trust is all about integrity. Again, do what you say. And as for advice, you get the money twice. Okay. So with that being said, that's what I had here, today. Again, the way that I want to finish it off, the session, unless anyone has any questions, and happy obviously to address the questions. So type them in on the question section. We'll cover them. But one of the things that I wanted to really discuss again, and I think that I discussed this on the last session, is that I am very concerned with what's happening on the market. I am very concerned with companies that are launching, that they don't really have a revenue stream that is very well defined, and they're already, like with over $1 billion in valuation. I am very uncomfortable too with public companies investing, a big amount of their assets into Bitcoin, where now the price of the share is directly related to the performance of Bitcoin. I am very concerned with what's going on. And my concern, the reason why I'm voicing this concern to you all is because it's not about just raising money. It's also about timing, how you are able to raise this money and when you're thinking about raising this money. If you are thinking about raising money, or you're raising money right now, you need to get out there and raise the money yesterday. Yesterday, you should have raised the money, because when things turn around, and when the market, really, corrects, then the problem is that money and capital is going to be drying up. Now, obviously, if you take a look at what happened in 2008, yes, it was a couple of months that was bumpy, but then, it continued to grow over the course of time. And I think that will be the same, because history repeats. But what I would be very, very sad to see is that some of you, perhaps way too long, you procrastinate, to really get this money in. And then when you're like literally in the middle of doing the raise, you get caught into this a storm where investors, are very worried, and they're trying to have, cash to perhaps, the risk, their portfolio. So, and typically, early stage companies, they tend to be anywhere between 5 to 7% of portfolios of those investors. Obviously, if we're talking about institutionals, then it's different. But that's the risky side. That's the side where they're going to be pulling back, quite substantially from, in the event of a downturn. So again, I think that right now is the time to really get out there, to raise the money, and you want to make sure that this is not cutting you in the middle of it. So again, if any of you is raising money or needs help, we actually help directly with Pantera Advisors, the advisory. You can just shoot me an email there. We help with everything from point A to point C with myself and Mike. Mike, you probably remember him from the financial modeling training. But let me just touch base on the financial model really quickly. I think that you should all do that course, that training of Mike, at least once or twice if possible, and really get what is needed for you to have a great, compelling financial model, because essentially that's going to be one of the biggest components that is going to help an investor determine whether or not you've done your homework. And again, you're going to be extracting that, creating beautiful graphs that you put into your own pitch deck. That's the way that you want to do it. That is going to set you apart from at least 80% of the founders out there. And remember, you're competing for the dollars, because that fund, that investor has certain amount of money that they have allocated to early stage companies like yours. So you want to make sure that you put the best foot forward so that you can really capture that money. And again, as you saw, only 60% or 58% of pitch decks really have that are successful, really have the financials. So there's just so many that don't. It's just going to make all the difference for you. Alrighty, so with that being said, we're coming to an end. I would recommend as well that you guys join, all these clubhouse rooms. I think it's very interesting, great people. Some of the top people in the venture world are there, and a great opportunity for you to mingle and to build some of those relationships. And it's actually starting out. So yeah. All right, guys. Well, thank you so much for being part of the inner circle. And as I always say, go out there and get what's yours, because it's all about being in action. What separates the people that succeed from the people that fail is the action that they took. So go out there and make it count. Thank you so much, guys and gals. Bye-bye.